is the Opal Dividends Podcast. I am your host, Jay Coulter. With me, Austin Graff, Adam Muller. We're getting right to the questions. Gentlemen, Jamie Dimon says the banking crisis is not over and there will be repercussions for years to come. Austin, what's your take?
I think it's fair. It might not mean that banks are going out of business or failing for the next few years, but it definitely means banks are going to have impaired earnings for some time to come. As many banks are stuck in these lower yielding securities portfolios, the only real option for them is to wait for those securities portfolios to roll off and then reinvest those proceeds at higher rates. And that's when we'll see kind of normalization of earnings in the financial institutions. We also likely have more regulation coming to bear on many of these regional banks, which will force them to be a bit more conservative. So the combination of lower earning securities portfolios and increased regulation doesn't bode well for banks in the next few years.
Hey, Austin, was today's issues, were they really caused by a lack of regulations, or was it just poor risk management by these banks?
I don't think it was lack of regulation. It was more poor regulation and poor risk management. Also poor oversight, right? So there was no test saying like, what's your duration risk in the underlying portfolio. So many banks ended up taking risks that either they didn't know about or the regulator wasn't challenging them on. And that's what caused the core of the problem here. It also leads to people to question what's the difference between actual accounting earnings and underlying economic earnings, as the core issue here happens to be many of these banks in not wanting to take accounting impairments or not wanting to write down accounting earnings. They just moved these assets off to another bucket where they didn't have to realize the losses, even though there is truly an economic loss in the event the short-term funding dries up, as we saw with Silicon Valley Bank. And we've also seen with Signature Bank in New York.
Adam, what's your take on the banking crisis? Is this going to play out for a while?
Yeah. Two things I'd love to add is one is, two of the biggest banking failures in U.S. history happened, but like 2 to 3 weeks ago. So that's very recent. We haven't even gone through an earnings cycle to see what the banks say about their businesses and what's happened to their business since this sort of came to light. So Jamie Dimon saying that it's not over. Of course, it's not over. Stabilizing deposits and stopping runs on further banks is how you plug the hole and keep things stable. But in terms of the actual impact on this, we won't know for some time. And it won't even just be one quarter will be some information, but I think what he's suggesting is it'll take years to really figure out how this has impacted the earnings ability of the banking system. And then you add on that potential future regulations and how that'll impact earnings power, et cetera. There's just a lot of uncertainty. And the other thing I'd say is what's interesting is in terms of what happened, you think back to the global financial crisis in 08 and 09, and a lot of banks had very risky assets, derivatives of derivatives, levered real estate assets under the thesis that real estate could never lose value, and then it did, and everything blew up. And what did the government say? What did the regulators tell them to do? Well, you can't own this stuff anymore. You got to own U.S. Treasuries. And that's what got them. That's what the problem was when the Fed raised rates at a historically high pace. These treasuries lost a lot of value, and the banks got burned. I'm not saying the banks aren't at fault, simply because they didn't manage their balance sheets properly as rates went up, and I think everyone kind of knew rates were going to go up at a pretty accelerated rate, but not 100. There's some shared responsibility, as Austin alluded to, with respect to the regulators and the Treasury and the Fed and everybody, which there usually is in these sorts of things. It's usually not one culprit. It's usually sort of a perfect storm of things that find that narrow thing that can blow everything apart.
So, Adam, one byproduct of these rates going up is thought to be some duress in the job market. So job openings came out today. Consensus was that we were going to see about 10.5, came in BLS reporting about 9.9, the first sub $10 million print. For a timestamp for listeners, we're recording this in the beginning of April. The trend is going in the wrong direction. What do we need to think about?
Well, first of all, we need to think about the fact that it's only one data point and I guess it's interesting that it's sub 10. We'll see with the BLS numbers probably this Friday. That'll be an interesting number to see. But like anything, you have to see some sustained change in direction on this data over weeks, months, if not quarters, to really know what's going on. But if you're the Fed, or if your view is that if you want to see the economy weakening and you want to see the labor market weakening, that's a much better print than if it was above 10. So it's I think that's why the stock market sort of opened higher, I believe, this morning after that number came out, or under the idea that maybe the Fed won't tighten or will loosen sooner, and then quickly reversed because people, once that first cup of coffee kind of hits the system, you're like, wait a second, does this mean anything? And the answer is maybe, but we won't know for a little while.
Austin, what's your take? Is this just a short-term data blip, or is it not, or is it enough information to start voicing some concern?
I don't think this data point on its own leads us to any kind of type of concern. It definitely kind of raises an eyebrow. One of the missing factors here is how many people are actually looking for jobs compared to how many jobs are available. And without kind of the whole picture, it's hard to tell what's going on. I think when you combine it with some of the other things going on in the economy, it's got a lot of people thinking that maybe the Fed's either nearing the end of rate increases or potentially even going to reduce rates in the back half of the year. But I think to come to a conclusion on either of those kind of perspectives, you need a lot more information, and we need a lot more consistency in the information. One of the things I would say we've seen through the first kind of quarter of 2023 is a lot of inconsistency in the economic data. And I can't tell you if that means that we're at the top and things are turning lower, or if that just means there's a lot of indecision in the economy, given what's going on with money flows and with kind of margins and inflation and all the other kind of economic variables that we've had our eye on.
So, Austin, I know that you have some significant exposure to energy in your portfolios. Oil analyst Paul Sankey came out and said that $100 oil could be the new normal. What type of impact would that have in a portfolio that has an overallocation to energy?
It would be tremendously supportive to a portfolio that has a high allocation to energy. I wouldn't call it an over allocation to energy. That would imply that we have too much energy. How we position the portfolio really relies on underlying business drivers. We see the economy slowing, but we think the fundamentals, even in a slowing economy, can be supportive for higher oil prices. And a lot of that has to do with the lack of investment in the oil patch. So there's fewer dollars going into creating supply, and the supply is falling faster than demand. Demand's actually increasing through 2023 because of the reopening of China. And we think that the demand from China actually could offset any decline that we see in a slowdown in the US. And on top of that, we have the Saudis who are supporting oil prices. And that has more to do with some geopolitical issues and the fact that they want to balance their own budget at home. So if you have the key swing producer recently switched from the US back to OPEC plus, if OPEC plus decides that oil prices should be higher, they're going to get them there, and that's going to be supportive to oil and gas companies, whether they be in the U.S. or internationally.
Adam, how do you look at $100 oil?
Well, look at it a couple of ways. One is I think if you at any point in time, if you polled all of the energy analysts, you're going to find someone that's saying $100 oil is the new normal. So you could always grab onto that if you wanted to. But the way I would think about it is there's almost two different curves for oil. If you think about oil price and sort of supply and demand kind of all conflated. And one is this sort of long-term trend, which is I think what Austin is getting at, of a lack of investment over time is going to lead to lower supply. And then bouncing around that, there's these more short-term peaks and troughs based off of what OPEC does. Is China reopening? Is it not reopening? It reopens, it closes again. Now it's reopening again. Any kind of geopolitical issues, wars, whatever, things like that. So, and if you, as a portfolio manager, I think what Austin's done an amazing job of doing is kind of splitting the difference in a way between those two curves, because you can't ignore the short-term fluctuations. You also can't predict, an exogenous shock like OPEC deciding to do something. But you can sort of logically think about what would you do if you were them. You just can't, So I think there were a lot of people that weren't necessarily surprised that OPEC is going to cut some production, but wouldn't have been able to sort of predict the timing or the amount. And then the other thing with OPEC is you also can never predict how many of them are actually going to follow through and to what degree. So there's always a haircut to the kind of headline number. But could oil, I don't know if $100 oil is the new normal. Could it get there again and then quickly? Sure.
Most importantly, we don't need $100 oil to generate great returns on our portfolio.
Right.
If we get $80 to $90 oil, the companies in the oil and gas space will be printing money hand over fist.
Okay. Let's switch gears to virtual reality. Disney, in trying to right their ship recently, I believe laid off their whole virtual reality department. A report out of CNBC says that only 4% of teenagers who own a virtual reality headset use it on a daily basis. And I can tell you personally, I bought a VR headset for my teenagers 2 Christmases ago, and it's been used twice. Adam, what are the implications of the lack of adoption of virtual reality through an investor's lens?
Well, I think if you were going to have a thesis that virtual reality is going to be something, you have to be thinking pretty long term. And I think that's true of most new technologies. It's very hard to predict an adoption curve for something as new and as different as strapping on a headset and go waving around in some virtual environment. And I think a lot of people aren't yet convinced on that's fully the direction we're going to go, and certainly that it's anything in the near term, to be worried about. It's sort of like at some point, will the majority of cars be electric, or let's just say it in another way, will the majority of vehicles at some point in the future not use internal combustion engines? Maybe. Should you not? Should you just be short oil and sell all the automakers that use conventional engines today because that could happen sometime in the future? God, no. It's going to take a long time. And I think VR, it's hard to predict. It's, how many people have Apple Watches now? And when those watches came out, people were like, And then all of a sudden you look around and so many people have them on. So you can't really predict the adoption curve, but it's coming in one form or another. And the process may be slow and it may pick up when there's more use cases. But any technology like this, to your point about teenagers, they're the one. If they start using it, it'll filter up. If I was making VR headsets, I would try to create some sort of social media platform to put on them, because that's how you get the kids involved. And then, before long, it'll move up the demographic curve.
Austin, we've been beating inflation to death for several quarters now, but the reality is it has an impact on portfolio construction. How are you approaching inflation as you build out your portfolios?
Yeah, you have to really think about interest rates when you're thinking about inflation. And one of the things we've thought about is, if inflation is stickier than most people expect, how does that impact the current interest rate situation? We think that leads to the Fed coming through on their perspective, or on their comments, that the rates are likely to be higher for longer. However, we don't put all of our eggs in that basket. And so when we think about positioning the portfolio for inflation, we want to own high quality dividend payers that can perform well in a high inflation environment, which, whether that be a high inflation, high growth environment, or a high inflation, low growth environment, which is a very real possibility given where we're seeing economic data going right now. And we also want to own companies that will perform well in a lower inflation, low growth environment. So right now our portfolio is relatively defensive with high quality dividend payers that generate significant amounts of free cash flows in various economic environments and distribute those free cash flows to investors in the form of growing dividends. Now, when we talk about dividends, I think one important thing to keep in mind is right now a lot of investors are saying, with the short-term treasuries in the 4 to 5% range, why would I own a dividend payer that's only paying me 3 to 4%? And in reality, that has to do with the fact that inflation can make your 4 to 5% treasury yield be worth much less in future dollars, whereas dividend yields tend to grow with inflation because many companies have pricing power to offset the impact of inflation. So the benefits of growing dividends are really important, especially when comparing an investment in a dividend payer relative to a treasury or a fixed income instrument, which is going to guarantee you a certain dollar amount in the future at today's dollars, but can't guarantee you the purchasing power of that dollar in future time.
Adam, geopolitical tensions are incredibly high right now. In fact, I don't remember a time where they were ever as high in my career. Do you feel the same? And then how do you go about managing money through that lens?
Oh, I think that's on any, when there's any kind of geopolitical issue going on in the world or the potential for one to flare up. I think that's just about, you can't predict when it's going to happen. You can't invest assuming it's going to happen, but you also can't assume it's not going to happen. So you just want to have, if you have strong companies that you want to make sure that you don't have investments that are generating a significant amount of their revenue and earnings from an unstable part of the world. So even an American-based company listed on an American exchange, if they're getting all of their revenue from Eastern Europe, maybe that's problematic and you just need to look into it. But if you take a balanced portfolio approach and have great companies at reasonable valuations that are growing, certainly if something flares up and the entire market sells off, you're not going to be immune to that, but you should do better than the market overall, which is the goal of a portfolio.
Yeah, I think one of the things we really try to do is think about probabilities and possibilities. And when you talk about geopolitics, especially the environment we're in today, what was historically a low probability event is becoming a higher probability event. And we're seeing more dramatic outcomes that are falling in kind of the realm of our range of possibilities. And so that when you think about investing, we haven't necessarily seen the volatility that you'd expect in an environment like this, but we believe as interest rates continue to rise and money continues to come out of the markets through the Fed's quantitative tightening, the volatility is going to pick up and we're going to start to realize some of these more extreme scenarios that we've kind of been protected by for the last 14 years in a QE environment.
Adam, we can't get away from ChatGPT. It's everywhere. Everybody's telling you that you're missing out if you're not leaning into that technology. What's your take on what investors should think about as it relates to artificial intelligence, machine learning, and ChatGPT as an investor?
Yeah, like there's no doubt that artificial intelligence is here and it's here to stay, and it's going to work its way into every sector of the economy. And with respect to investing, what I would tell investors is be mindful of investment products or things that are being pitched to you, claiming that they use artificial intelligence to make better stock selection or better portfolio allocation decisions, or any guidance. And just make sure what you're looking at is make sure it's real, make sure that it works, because that stuff is coming. It's a buzzword. So including it in marketing materials for investment help is there's probably something that already exists out there that I don't even know of, but it's definitely coming. But that said, it doesn't mean it can't help. It can help people do research. It can help with the right targeted questions. It can save an investment professional a lot of time. For example, looking through earnings transcripts for certain keywords and things, which is already being done. It's sort of another way of combing through big data, but it's here to stay. Watch out for it, and just don't think that anything branded as artificial intelligence necessarily means that it's helpful. Just be careful.
Austin, let's talk about passive investing. inflows into these structures have been massive. As an active ETF manager yourself, how do you justify the value of active management in today's market?
Yeah, it goes back. I mean, I can give you an example. If you look at a lot of the passive dividend ETFs right now, many of them have significant allocations to regional banks, and they aren't going to make adjustments to those allocations until they get up to the next quarterly, semi-annual, or annual rebalance. As an active manager, we're able to on the fly say, hey, there's something off in the regional banking system. We don't believe these companies or these banks are going to generate the earnings power that previously was expected, and we can make the adjustment going forward. Now, the past kind of 14 years of free money have kind of driven up all companies, regardless of valuation. It pushes stock prices higher, regardless of fundamentals. Bigger companies just continue to get bigger, and that can be shown in the fact that some of the, I mean, even the S&P has 13% of the weighting in two companies. You look at the Qs, and they have a quarter of the weighting in those same two companies. And so by actually be able to go through and value the underlying companies, as money costs something, valuations will become more important again. And we believe the value of active management will shine very brightly as we enter this new environment. If you look at kind of 2022, you saw some active managers perform very well when the passive managers did poorly. The first quarter of 2023, we saw passive kind of take over again. And that's when the market started to think that interest rates were going back down. So it's kind of this preference for free money pushes investors towards passive. When money costs something, active tends to be a bit better because people can go through and do valuations and pick the winners from the losers better than machines can.
All right, gentlemen, we're going to do the lightning round now. Brand new to the Opal Dividends podcast. You haven't even been prepped. You have 30 seconds or less to make a bull or bear case for the stock that I throw out. I'll rotate who goes first because the other person obviously has a 30-second head start. Adam, I'm starting with you. Charles Schwab.
Oh, I would take the bull side of that and say that, you know, Charles Schwab is an example of the baby getting thrown out with the bathwater. The stock's down with all financials, but the business model is it's not a pure play bank. It's not subject to the same issues that have caused a lot of concern amongst regional banks. Loan to deposit ratio for Charles Schwab, the bank, is something like 10%, which is very manageable. They have plenty of liquidity. And most of their, a significant amount of their earnings power has nothing to do with loans and deposits. So,
all right, that's your time, Austin. Charles Schwab, quick. Bull or bear?
Do I have to take the bear case, or I can take the bull case?
Whichever way you'd like. You just have 30 seconds.
I think it's a bull case. If you look at it over the next kind of 3 to 5 years, as more advisors are transitioning to the independent space, Charles Schwab has been a key beneficiary. While there's a focus on the bank right now, I believe over time that banking issues are going to kind of dissipate, and the earnings power is going to be resilient for kind of a best-in-class operator in space.
You're first in the second round. Intel. What you got, Austin?
I'm a bear on Intel. There's so much competition in some of these more advanced semiconductors. You know, Intel is a cheap company. They've done a pretty terrible job of execution over the last decade plus. They've essentially handed over their business to all the competitors. And now if you're buying Intel, you're essentially banking on the fact that they're going to steal that business back through superior engineering and superior execution, which hasn't been proven yet.
Adam, Intel, bull or bear?
I would also take the bear on Intel, but bull on semis, in the sense that over the next 5 to 10 years, I think semiconductor, the growth as the world just continues to digitize will be significant. And when you have such a secular tailwind for a sector, the best approach is to go best in class, and that's not Intel today. So I would bull semis, bear Intel.
Next stock, Altria. Adam, you're first.
Look, Altria is a cash a cash flow machine that is saying and doing all the right things with respect to moving into less harmful products, with a commitment to the dividend and to grow the dividend. So as an income investor, seems like a very reasonable sort of pillar of a portfolio.
Was that a bear or a bull?
That was a bear bull. A bull. A bull.
Austin, what you got on Altria?
I think it's a good company from a cash flow perspective. They've got they have the legacy business, which is combustible cigarettes, that generates a lot of cash. They've been allocating that cash to newer businesses, which they haven't done a good job of executing on to date. But they have a pretty clear plan into getting into the non-combustible business. We think it's a business that has higher profit margins, more cash flow potential. And as they make that transition, the current valuation is going to look significantly undervalued relative to the future prospects.
The last stock, Walmart. Austin, you're first.
It's an interesting one. I think that I'm a bear on the valuation, but I'm a bull on the company in the current environment. And so where I come from there is, it seems like we're going into an economic recession, and in a recession, companies like Walmart tend to do better just because of the stability of the business. However, the valuation kind of scares me. So in the short term, Walmart might do relatively well. I think over the long term, it might struggle a bit more, just because the valuation is quite high, and they have to earn or generate some earnings to compensate for that valuation.
Adam, close us out with Walmart. Bull or bear?
I'll go tepid bull, because I agree with everything Austin said. I do think that there is a kind of a brand value embedded in that valuation, and maybe that doesn't go away as in a slower economic period. If people trade down and Walmart does well, maybe that valuation, maybe the valuation holds up. So it's not my favorite, but I can't bring myself to call it a bear.
Excellent. Hey, good job for your first lightning round with not knowing we were going to do it. I think that's going to make the final cut. You guys did a good job. Viewers and listeners, sign up for the Opal Dividends Digest by visiting opalinvest.com. That's opalinvest.com. And don't forget to follow Opal Dividends on your favorite social media handle. Gentlemen, we'll see you next time.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital, LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.